Thank you for joining us today. Please note that there is no CPE attached to this webinar. Please view our upcoming events and webinars at cbh.com for CPE opportunities. Our presentation will begin in a moment.
Well, welcome everybody to our 2019 DCAA update, somewhat an annual event for us where we review some of the latest and greatest developments that come out of DCAA. My name is John Carpenter, and I'm joined today by two of my colleagues, John Ford, a senior consultant in our government contractor group. John is a former associate at DCAA. He was actually the Deputy General Counsel when he left government service. And John has been with us for a number of years. Kurt Smith, a manager in our government contractor group. Kurt was an auditor and had the pleasure of working both in a field office and a branch office and in several other capacities with DCAA. So we're very pleased to have both of them with us today to bring their own experience from DCAA as well as recent experience here at our firm into today's discussion. Here's our agenda for the day, which I'm not going to read all these bullets, but you'll see we're going to cover everything from some recent developments on cost and price analysis to talking about what's going on with certain types of unallowable costs, incurred cost audits, some recent reports on business system audits, and a recent IG report on executive compensation, always a topic near and dear to business owners' hearts. And so with that, I am going to, Kurt, turn it over to you to kick us off talking about cost and price analyses.
All right, thank you very much. So the first topic is an MRD, or Memo for Regional Directors, published by DCAA, concerning audit guidance on revision of incomplete or inadequate prime contractor cost or price analyses. It's MRD 18 PSP 006R, published November 27th, 2018. So FAR 15.4043B requires the prime contractor or higher tier subcontractor to conduct cost or price analyses to establish the reasonableness of the proposed subcontract prices. FAR 15.4043B requires that the prime contractor include the results of these analyses in its proposal. Audit of the prime/higher tier subcontractor's proposal should include procedures to determine if the analysis was completed and evaluate the adequacy of the analyses. FAR provisions, however, do not apply unless incorporated into a solicitation or contract. And there is no FAR clause that implements FAR 15.4043B. However, FAR Table 15-2, which is incorporated in FAR 52.21520, requires prime contractors to conduct price or cost analysis on subcontractor proposals. Cost analysis versus price analysis must be performed when the subcontractor is required to submit certified cost or pricing data. Analyses are submitted as part of the contractor's certified cost or pricing data when the proposed subcontract is expected to exceed the TINA threshold of $750,000 or the revised statutory threshold of $2 million granted by deviation by certain agencies, including DoD and DOE. If the analysis is not completed or is inadequate, auditors should perform alternative procedures to establish a reasonable basis for the audit opinion. Depending on the overall risk and materiality, the audit team may, amongst other options, create a decrement based on purchase order history, create a decrement based on other relevant information, such as historical analysis or negotiated amounts, and or request an assist audit of the subcontract proposal.
The performance of alternative procedures by auditors does not relieve prime or higher tier contractors of the responsibility to perform cost or price analyses of subcontract proposals. Accordingly, the audit report should identify amounts associated with incomplete or inadequate cost or price analyses as a material noncompliance, that is, a noncompliance with FAR 15.4043B.
If the audit team is unable to obtain sufficient appropriate evidence through the performance of alternative procedures, and this is per the MRD, not per case law, as we've just observed, the audit team should classify the associated costs as unsupported, including material noncompliance, that is noncompliance with FAR 15.4043B, as discussed, and include a scope limitation in the basis for the audit opinion section of the audit report. A scope limitation being simply a situation where the auditor was unable to obtain sufficient evidence for the basis of the auditor's opinion. And scope limitations come in a wide variety of situations, flavors, what have you, but it's just a simple fact that the auditor could not conduct or gain enough evidence to support an opinion. The MRD contains an FAQ section, and we picked out an especially pertinent point, we think. So the question is, if the prime or higher tier contractor is denied access to the subcontractor's cost data, does the prime or higher tier contractor have to perform any analysis of the subcontractor's proposal? The answer is yes. At a minimum, the prime or higher tier contractor should perform and document its efforts to complete the FAR 15.404 required price analysis of its subcontractors and coordinate with the contracting officer to obtain any necessary audit or pricing support from the government. And an example of this that I actually ran into as an auditor was where a large defense contractor had a subcontract proposal from another large defense contractor. And the large defense contractor that had proposed a subcontract was unwilling to share its cost or pricing data with the prime large defense contractor. So that prevented the prime from conducting any sort of analysis of the subcontract proposal. So this happens frequently amongst large contractors. And so in that case, the prime would have to turn to the government to obtain auditor pricing support.
Okay, I'll take it from there on this next one to talk about this next MRD. DCAA has issued a series of MRDs on expressly unallowable cost. And in May of this year, they issued another of these MRDs talking about expressly unallowable cost. And what this one does, this latest MRD, is to revise the guidance on identifying expressly unallowable cost. And as the MRD says, due to recent court cases, but the MRD did not identify what the court cases are. The MRD also updates the guidance for determining whether a cost principle identifies expressly unallowable cost. And what the MRD says is that per recent decisions for a cost to be considered expressly unallowable, the cost principle must state in direct terms that the cost is unallowable or leave little room for interpretation or differences of opinion as to whether the particular cost meets the allowability criteria. Now, let's talk about that just a little bit to give an example of what we're talking about, expressly unallowable cost. Interest is always one of the big cost principles and one of the big issues that always comes up. The interest cost principle talks about interest on borrowings being unallowable. So you have to look to see what is the interest related to. Is the interest related to borrowings, however represented, or is it interest that the contractor incurred for some other reason? I'll give you an example from an ASPCA case from a few years back where a contractor had made an underpayment. There was a dispute as to the taxes that the contractor owed to a state. Ultimately, the contractor lost, had to pay additional taxes plus interest on the underpayment of the taxes. The contractor claimed interest on the unpaid taxes, and DCAA questioned that interest, saying that it was unallowable under the interest cost principle. when this went to an appeal to the ASPCA said no, that interest for underpayment of taxes is not interest on borrowings, because the government had not shown that the contractor intentionally underpaid the taxes so it would have the money for a certain period of time. So it was not even an imputed borrowing. So you can't just look, you have to be precise in looking at what a cost principle may say in regard to interest or any other type of cost in making that determination as to whether it is an allowable cost or an unallowable cost. Similarly, if you look at the advertising and the public relations cost principle, some advertising and public relations is allowable, other advertising and cost or public relations costs are unallowable. So you have to read the cost principle very closely to make a determination as to what is allowable and what is expressly unallowable. So if the government is going to assert that a cost is expressly unallowable, the government has the burden of showing that it was unreasonable under all circumstances for a person in the contractor's position to conclude that the costs were allowable. So if there is any colorable argument that you can interpret the cost principle as making a cost allowable, it cannot be determined an expressly unallowable cost. Because remember, the test for unallowability is that it's clear and unmistakable that the cost is unallowable and there could be no reasonable argument as to its allowability. Now, in that regard, as to showing whether a cost is allowable, unallowable, or expressly unallowable, if the government challenges a cost on allowability grounds, the government has the burden of proving the cost is not allowable. Now, this is one thing where DCAA, if you read DCAA audit reports, where they are questioning the allowability of the cost, the DCAA audit report quite frequently will say the contractor has not shown that the cost is allowable. That is reversing the burden of proof as to the allowability of the cost. If that question cost goes to an appeal before a contract appeals board or the Court of Federal Claims, the government will have the burden of showing that the cost is unallowable. The contractor will not have the burden of showing that it is allowable. So DCAA reverses the burden. And while we're talking about this, let's just make sure everybody understands the government has the burden of showing that a cost is unallowable. The contractor has the burden of showing that a cost is reasonable. So if it's questioned on reasonableness grounds, the contractor has to show that it is reasonable. If a cost is questioned on allocability grounds, the contractor again has to show that the cost is allocable to a contract. Now, that one of the things that we need to understand are definitions and the distinctions between unallowable cost and expressly unallowable cost. The FAR defines an unallowable cost is any cost that under the provisions of any pertinent law, regulation, or contract that cannot be included in prices, cost reimbursements, or settlements under a government contract to which it is allocable. And an expressly unallowable cost means a particular type of cost which under the express provisions of an applicable law, regulation, or contract is specifically named and stated to be unallowable. So let's give you an example of what would be an unallowable cost, but not an expressly unallowable cost. That would be a cost which is otherwise allowable, but is questioned on reasonableness grounds. so that the amount that a contractor is paying for labor, which we'll talk about a little bit later on in this webinar,
Like say executive
compensation, which is below the cap, the government may question a cost as being unreasonable. Executive comp is an allowable cost as long as it's reasonable. So it can be held unallowable on reasonableness grounds, but it would not be expressly unallowable. On the other hand, if the contractor claimed executive comp that exceeds the cap, that would be an expressly unallowable cost. So the same cost, when you're dealing with the same cost, can depend on the context in which the cost is being questioned as to whether it is an unallowable cost or an expressly unallowable cost. Now, what's the significance of it being unallowable or expressly unallowable? Well, that comes in regard to the application or the assessment of penalties. FAR 52-242-3 provides for the assessment of penalties against a contractor for including expressly unallowable cost in a proposal. Now, what type of proposal? Can it be a proposal to get a contract? Well, no, that's not the type of proposal that we're talking about for the assessment of penalties. The clause defines a proposal as a final indirect cost rate proposal, which is the one we generally think about, or the final statement of cost incurred and estimated to be incurred under the incentive price revision clause. So if you have a fixed price incentive contract and you include an expressly unallowable cost in the proposal to establish the final price of that fixed price incentive contract, you can have a penalty assessed against you for including that expressly unallowable cost in the proposal. Note, there are other types we just mentioned a minute ago. A proposal to get a contract is not covered by this penalty. A request for equitable adjustment, a pricing proposal submitted in regard to an equitable adjustment, is also not a type of proposal where you can have penalties assessed against you. Also, proposals, termination settlement proposals after a convenience termination is not the type of proposal where you can have penalties assessed against you if the termination settlement proposal includes expressly unallowable cost. You have to be aware of what we're talking about, proposals. All right, and now I'll let Kurt talk about something that's fairly new here for DCAA.
And that topic is materiality in incurred cost audits. And this is an MRD published by DCAA recently on July 19th, 2019. It's MRD 19 PAS 003R. And it is in response to Section 803 of the 2018 National Defense Authorization Act, which requires DCAA to adopt commercially accepted standards of materiality for incurred cost audits. This MRD establishes audit policy for applying materiality in incurred cost audits that are initiated after the date of the MRD. Materiality considers both qualitative factors, that is customer concerns, prior findings, and quantitative factors. The relative importance of qualitative and quantitative factors when considering materiality is a matter of auditor professional judgment. Auditor professional judgment are three big words, and so let's put some parameters about that in the context of materiality. To calculate the quantitative materiality threshold, the auditor should first determine the total subject matter of audit. The total subject matter of audit is generally auditable dollar volume plus amounts associated with assist audits. ADV is defined as the cost incurred in performing flexibly priced government contracts. e.g. cost type and time and material contracts during a fiscal year. The auditor should calculate quantified materiality using one of the following formulas. For proposals from $1 to $1 billion, use the formula 5,000 times the total subject matter divided by $100,000 to the power of 0.75. For proposals greater than $1 billion, use a percentage of 0.5%. And to flesh this out just a little bit, in the MRD, DCAA actually lists various amounts of total subject matter, if you will, and the materiality amounts associated with them. For example, if a proposal contained $1 million of total subject matter, the materiality amount would be $28,000. And if a proposal were $100 million, the materiality amount would be $889,000. So to put that in context, the auditor would take the threshold of $889,000 and look at each cost element in the proposal to see if the amount of the cost element exceeded $889,000. It's pretty simple. And in a proposal of $100 million, labor and material more than likely would be over that amount. But within labor, there is direct labor, and then there's various types of indirect labor. So just continuing with this process, the auditor would look at direct labor, which might be $20 million, certainly exceeds the threshold amount. The auditor would look at the various GL accounts containing indirect labor. If the contractor had, say, 3 overhead pools, each of which had its own GL account for indirect labor, the indirect labor for one overhead pool, say engineering, might be $10 million. The overhead or indirect labor in the manufacturing overhead pool might be $20 million. And then you might have a third pool, which is a very small overhead pool, and indirect labor might be $700,000. So the auditor, just using this amount of $889,000, would not audit that third indirect labor account. However, this introduces the concept of qualitative materiality and auditor judgment. So as I was saying, materiality requires the use of 2 separate thresholds: quantified materiality to identify significant cost elements, and adjusted materiality to identify significant accounts recorded in significant cost elements. Adjusted materiality is less than quantified materiality and is applied to GL accounts within a cost element, as I was just describing. And for purposes of selecting GL accounts for audit testing, adjusted materiality can be stated as a reduction of the quantified materiality threshold based on auditor judgment. Now, within the MRD, DCAA describes a 20 to 80% reduction of the quantified materiality threshold in terms of adjusted materiality. So taking this $889,000 amount that we're working with in this $100 million total proposal, an 80% reduction would take that from $889,000 to $178,000. So given circumstances where the auditor feels that it's very important to test a particular GL account for various reasons, the auditor could test a GL account containing as little as $178,000. The auditor does have to document the auditor's reasons for testing this lesser amount. And normally that's going to come into play when the customer, that is the government customer, has expressed certain concerns and asked the auditor to focus on perhaps certain types of costs. Another example would be where there have been previous findings in a particular area of cost with a certain contractor, and DCAA is very concerned about that particular cost in the current proposal, amongst other types of issues that might crop up. John, I'm going to let you handle contractor business systems. I know they are near and dear to your heart.
All right. The next subject we're going to talk about is a report that GAO did almost a year ago in February of 2019 addressing how DoD was complying with statutory requirements for implementation of contractor business systems and contractor business system reviews. And so this was quite an extensive report by GAO, and it dealt, as I said, it dealt both with DCMA and with DCAA processes in regard to business systems. Just as a review, there are 6 DoD business systems. DCAA is responsible for 3 business systems: accounting, estimating, and earned value management. DCMA is responsible for 3 other business systems, that is purchasing systems, material management, and property management, in other words, government property. But even though we say DCAA is responsible for 3 systems, DCAA, what we mean by that is that DCAA is responsible for reviewing these 3 systems and making recommendations to the ACO as to whether the system is adequate or not adequate. Generally, DCAA will not make a recommendation of adequacy. They will, if they do a review and determine the system is adequate, that will generally be the end of the matter. If DCAA considers the system to be inadequate, they will refer their inadequacy recommendation to the ACO, who will then make a determination as to whether, an initial determination as to whether the ACO agrees with DCAA. If the ACO does agree with DCMA, the ACO will issue a preliminary notice of inadequacy to the contractor, require the contractor to develop a corrective action plan, and also on covered contracts, which are CAS covered contracts, start withholding money due to the contractor on future billings, that is progress payments plus invoice payments. And the contracting officer can continue to do this withholding until the contractor has submitted an adequate corrective action plan, and where the withholdings can be reduced. And then once the contractor has submitted a final or taken final corrective action, the ACO will release all withheld monies to the contractor. So it's not that the contractor is being denied ultimate payment, it's just a timing issue as to when the contractor will get the money that is being withheld because of these system deficiencies. So that's generally how the system works. Now, timing-wise, DCMA and DCAA have a goal of conducting business system audits at contractors generally every 3 years. Also, I think it's for the property management, DCMA has a goal of doing a review 1 to 3 years. So contractors would generally not be subject to a business system audit every year, but only every 3rd year. What GAO found was, in regard to DCAA, since that's the subject of this webinar, that between the years 2015 and 2018, DCAA had conducted only 39 business system audits.
Now, John, I'm going to interrupt you here for a second and say, we know that the accounting system is one of the relevant business systems we're talking about here. And by golly, we know that it seems like at least every branch office of DCAA probably does 39 accounting system audits every month. I mean, we see accounting system audits happen all the time. Do you have any? Surely 39 seems like too low a number. What do you think's going on in the report?
Yeah, the report doesn't define what is a business system audit. So that leaves it open to what are they talking about? And as you said, we see audit reports all the time where the contractor is being written up for deficiencies in its accounting system.
And indeed, we see the frequency of audits of the other systems such as purchasing, material management. Those audits are definitely less frequent, but it just really calls into question where did this 39 number come from?
Right. Well, on an estimating system, if the DCAA writes up a contractor for defective pricing, which they're not doing very often these days, but if they do, it's not unusual, in my experience, to see a comment about the contractor's estimating system, because defective pricing and submission of adequate cost of pricing data is a component of a proper estimating system and the use of that data. So what I am suspecting, what they're classifying as business system audits, are audits of contractors that hold CAS-covered contracts. Because as I mentioned before, it's only covered contracts, which are CAS-covered contracts, on which the contracting officer can do withholding. So it doesn't make much sense from a resource standpoint for DCMA or DCAA to be spending much time on contracts where there is not going to be any real stick for the contracting officer to go after the contractor for non-compliance. So if you have, say, a small business, and these business system clauses apply to small businesses, if you have a small business that has an issue with its estimating system, there's not much return. And how much risk is there really involved with a small business having a bad estimating system that you can accommodate through audit and oversight?
Right.
So that's what I'm suspecting, that it's CAS-covered contracts.
That makes sense.
Yeah. Or contractors with CAS-covered contracts. Now, what happened, you have to go back and look what was going on between 2015 and 2018. This is when DCAA was dealing with their 28,000 incurred cost audits of a backlog of audits of that magnitude. So what was happening during this time period, 2015 and 2018, is that DCAA was devoting a substantial percentage of its audit effort toward clearing that audit backlog and not devoting time to the business system audits that they should have been doing on the audit schedule of every 3 years. And during this time frame, what DCAA said, that they were only focusing their audit effort on business systems that DCAA considered to be high risk. And the GAO report included or discussed what DCAA included high risk indicators, such as the contractor's current system status, had we approved it in the past, did it have deficiencies in the past, the contractor size in terms of dollars under contract. Again, as we mentioned before, dollars would certainly be a risk. The amount of cost type contracts under performance. If you have firm fixed price contracts, those are generally not going to be causing you much risk on your business systems. For example, accounting system review. What do you worry? How much risk is there in having a defective accounting system if you have a firm fixed price contract? Organizational changes. Did you buy a segment? Did you dispose of a segment? Changing in your business model, audit request by a contracting officer, and the types of deficiencies identified and its impact on cost and schedule. So these are what DCAA considered high risk factors.
In this GAO report that we've been talking about, as of November of 2018, DCAA identified 2 GAO 285 business systems that require an audit. And DCAA plans to perform these audits, these 285 business system audits, between 2019 and 2022, with most of the audits, 104, planned for 2020 this year. Though because of the planned implementation of this audit plan that DCAA has come up with or represented to GAO, those of you who are subject to business systems audits should have seen some increase last year and would expect to see some more increases this year. And for perspective, DCAA reported that it issued 3,717 audit reports in 2018. So 104 audits planned for this year, 2020. When you look at the overall number of audit reports that DCAA does, you'll see that the number is quite small. Also, in regard to 2018, and these are fiscal years, by the way, not calendar years, DCAA issued 15 business system audit reports. So 15 of those 3,717 audit reports issued by DCAA in fiscal year 2018 were business systems reports. Now, as an editorial comment, the statistics in the report indicate to me that it may be time for DoD to rethink the effect of the DFARS business systems clauses, particularly their impact on small businesses, because since the universe of contractors that are having to comply with the various requirements as contrasted to those who are actually being reviewed and where the business systems clause applies for withholding of money, there seems to be a possible disconnect between requirements for application of a system and systems where DoD can really take corrective action through, or require contractors to take corrective action through the withholding of money. The next topic that we're going to talk about is a DoD IG report that was issued in March of last year that evaluated how DCMA contracting officers were treating DCAA audit reports that questioned executive compensation cost, which is one of our favorite topics in Cherry Beckert and Contractors, since DCAA loves to question executive compensation, and it results quite frequently results in some prolonged actions and interactions between DCAA, the contractor, and the ACO.
Our favorite topic again, executive compensation.
Yeah, so let's talk about this a little bit. Under the FAR, and there is a DoD instruction, that's 7640.02, follow-up on contract audit reports. If a contracting officer does not sustain DCAA audit recommendations, and that's a key point, what's in an audit report are only recommendations. They're not directions and not conclusive findings. The contracting officer is required to adequately explain his or her rationale in the negotiation memorandum as to why DCAA's recommendations were not followed. And the IG evaluated DCMA contracting officer actions on 35 DCAA audit reports that questioned $58.1 million in claimed DoD contractor executive compensation. For 18 of those 35 audit reports, the IG determined, and it's the IG's opinion, that DCMA contracting officers failed to comply with the FAR and the DoD instruction requirements, document an adequate rationale when they did not sustain DCAA's recommendation.
So I was a DCAA auditor for 12 years, and I will say that it's very frustrating for DCAA's auditors to work so hard to develop their findings. And despite all the times that DCAA does not do their job perfectly well. They still work very hard, I will say, day to day to do a good job, the best that they can. And so they work very hard to develop their findings, and they, as you can understand, are disappointed when DCMA does not support their recommendation. Sometimes they just, in my opinion, they just don't understand at all why DCMA doesn't support them. Having said that, the practice at DCAA, I still think it's the practice today. It certainly was when I was there just a few years ago. In terms of executive compensation, all executive compensation reviews essentially are conducted by a team based in Maryland. I think it's called the Mid-Atlantic Compensation Team. And their audit procedures consist of reviewing, comparing claimed executive compensation to results of surveys conducted by various third parties, and essentially salary surveys or compensation surveys. And I will say this, that when I was there, I found that the compensation team's methods were under their procedures made sense, but at the same time, they were very aggressive. So I am interested to learn more about this. And so please continue, but just my comment being that there are times when DCAA may not appreciate the fact that DCMA did not support their recommendations, but DCMA's actions to not support them are completely supportable.
Thanks for giving us your perspective on that, or former perspective. Now you're on the dark side. Okay.
Yes,
so
this is true.
What the IG found out of those 18 audit reports is that the 18 contracting officers documented one or more of the following three reasons for not sustaining the DCA recommendations. First of all is DCA's findings were not credible because two ASPCA cases had rejected DCA's use of a 10% range of reasonableness factor. I'm going to talk about that in more detail a little bit later on, but just keep that one in mind. The addition of locality pay to DCA's calculated survey average effectively eliminated the executive compensation that DCA identified as unreasonable, and grouping of the contractors' executives into one job class offset the executive compensation that DCA identified as unreasonable. And the IG didn't buy those. This is why the IG was coming back, issued this report, and didn't buy these reasons as to why the contracting officer did not sustain DCA's recommendations. First, in regard to the two ASPCA cases, the IG said that the board did not reject DCA's use of a 10% range of reasonableness factor in all instances. Second, the contracting officer did not justify the need to add locality pay to the DCA calculated survey average. And finally, the contracting officers did not explain how the grouping of executives in one job class was appropriate or met the definition of job class in the FAR. And what the IG recommended is that the DCMA director implement either a program whereby contracting officers may seek advice from qualified personnel with extensive knowledge on executive compensation.
Wonder where they're going to find those.
Yeah, because DCMA doesn't have these so-called executive compensation experts. They just have ACOs that are trained in the FAR and what the cost principles are. They have some attorneys who have had the unfortunate experience of having litigated before the ASPCA and trying to defend the DCA audit reports that were mentioned or referred earlier in these two ASPCA cases. And as a result, the DCMA trial attorneys are a little bit gun shy about going forward now on DCA audit findings of unreasonable executive comp until DCAA changes its procedures. And, or what the IG also said, it recommended that the DCMA director do is to issue guidelines and training on executive compensation concepts and approaches for taking action on executive compensation audit findings in a consistent and appropriate manner. Also, the IG recommended that the DCMA director provide refresher training to contracting officers on the requirement to consult with legal counsel when their disagreement with an audit finding is based on an interpretation of a law or regulation. And let me comment on that one a little bit, because in one of my earlier lives, I was essentially the counsel to DCMA. This before DCMA broke off from DLA. I was at one time the associate counsel for contract administration services at DLA, and that was the predecessor to DCMA. It is very unusual for a DCMA contracting officer to take any action without going to his or her legal advisor and getting recommendations and cover. The lawyers in DCMA and DLA and most of DoD are the guys that provide, or the people that provide cover for contracting officers. Gee, Mr. Contractor, I'd like to do it, but my lawyer won't let me do it. Or, gee, Mr. IG, I went to the lawyers and they told me I could do it. So if you want to talk to somebody about this, go talk to the lawyers. So, you know, this is the cover that the lawyers in DoD provide to contracting officers from almost everything. So I would be very surprised if these 18 contracting officers had not already had some sort of conversations with their attorneys about what they were doing. For these recommendations, DCMA concurred with the recommendations. So let me go back into this. If we go back a couple of slides, we see where the IG is saying the two armed services, the two ASPCA decisions did not reject DCA's use of a 10% range of reasonableness factor in all instances. Let's talk a little bit about executive comp and what the two board cases held. Executive comp that we're talking about is compensation below the ceiling. Okay, any compensation below the ceiling has to be evaluated for reasonableness. And the compensation cost principle, 31205-6B, is where we're talking about reasonableness of compensation. What that says is that compensation has to be evaluated based on factors that the contracting officer may determine to be relevant. Among the factors that may be relevant, the key word being may, are compensation practices of firms of similar size in the similar geographic region based in or performing the same types of services or providing the same types of supplies as the contractor under examination. So engaged in the same line of work. Notice that the cost principle does not say these are mandatory factors. These are factors that may be determined relevant. Okay? Their weights are up to the evaluator. What weight are you going to be giving to similar size, similar business, or similar geographic area? That is a judgmental factor. Okay. Also, you have to consider the reasonableness cost principle. It says a cost is reasonable if in both its nature and amount it does not exceed that which would be incurred by a prudent contractor in the conduct of a competitive business. So that is something you have to keep in mind. What DCAA does, as Kurt alluded to a minute ago, there is a team in Philadelphia that this is about all they do is do executive comp reviews. Their process is based on a process that was described in an earlier ASBCA decision called Tech Plan. Under Tech Plan, the process, what the board said there is compensation professionals will generally follow this procedure. Didn't say this is required by the FAR. It just said this is what compensation professionals do. What they will do is they will select the position to be evaluated, CEO. Then what they will do is they will take surveys that will give reasonable, comparable factors for evaluating the compensation of that CEO. What DCAA does, they have a whole list of surveys that they use, and they will usually try to use between 3 to 5 surveys in doing an evaluation.
And these are surveys we've run in. These are surveys generally from national firms like ERI, like Towers Watson, people like
those
that.
Are favorites.
Yes.
And what DCAA will do is to take the median of the compensation range, the 50th percentile in these compensation surveys, and say that is where we're starting from. That is our benchmark. They will take the average of the 50th percentile of the surveys that they are using. Then to smooth out those surveys, they will add what is called a range of reasonableness, and that range of reasonableness is 10%. Once that is applied to the compensation, the average of the 50th percentile of the 3 surveys plus a 10% range of reasonableness, that is where DCAA comes down and says that's a reasonable amount of compensation for this exec to be earning. Now, one thing you notice, what DCAA does is to use national surveys, and they don't adjust for locality. For example, San Francisco, we know, is a high-cost area. If you have an exec in San Francisco or Silicon Valley, DCAA is not going to make an adjustment for the fact that you're there in Silicon Valley, you're in a high-cost area, and so you're being judged on a national average and not on a local average. So that is a defect. A contractor, a couple of years ago, a contractor, J.F. Taylor, challenged audit findings by DCAA that were sustained by a DCMA contracting officer. Taylor went to the ASBCA and hired a statistician to evaluate the surveys that DCAA was using and DCAA's procedures for determining reasonable compensation. The statistician determined that the surveys were not statistically reliable, and that the use of the 10% range of reasonableness also was not statistically reliable. So as a result, the board sustained the contractor's challenge to the question cost. One thing in Taylor, the government did not present a statistician to counter the testimony given by Taylor's statistician. So the fact that the government didn't have a statistician to counter Taylor, the statistician's testimony was uncontested. So that is what DCAA has not changed its procedures as a result of Taylor and a subsequent case called Metron, because DCAA comes back and says the board didn't understand what we were doing, and the board ruled the way it did because the government didn't challenge the statistician that testified for Taylor. So because of the board's lack of understanding and the fact that the statistician went uncontested, we're going to stick with what we're doing, and we think Taylor was a bad decision, and we're not going to follow it. So unfortunately, it looks like the IG is encouraging DCAA to keep going with its current practices, ignore Taylor, force DCMA contracting officers to do a little bit more analysis, probably getting a canned legal memorandum explaining what Taylor and Metron hold. And if DCA continues to do what they're doing and the contractor challenges the contracting officer, pull out the canned legal memorandum and put it in the file, and there you go.
So in other words, it seems like business as usual will continue to be business as usual.
DCAA will continue to challenge executive comp. Contractors will have to contest that, get it to the ACO, and hopefully they'll have an ACO that will say, yes, I'm the one that has the warrant and is charged with making the decision, instead of, well, if DCA issues the audit report, I've got to follow the DCA audit report, which we have seen happen. And that is, as far as Gump said, that's what I have to say on that.
Well, John, thank you very much for that. And yes, all kidding aside, we know that oftentimes business as usual just proliferates itself within the government.
Right, and it keeps us occupied.
Yes, it does. Well, that's all we have time for today. We thank all of you participants for dialing in, listening in to our thoughts today. You've got our contact information here. We certainly welcome your questions, comments, and follow-ups. And we thank you for joining us today, and have a good rest of your day and week. Thank you.